Hi Lisa. I am Marisa. Tom asked me to connect with you. How are you doing?
I'm doing great, Marisa. Welcome on board. It's so nice to see you here.
Same here. Is it a good time to take a brief from you about the government advisory practice?
Yes, sure. I am glad to take you through that. What do you want to know?
Lisa, I have just joined the organization. I am not even aware of what is public-private partnership, which we say PPP. Can we please start with that?
Sure, Marisa. PPP is nothing but when government does not want to create or build something. It would call some private players with expertise in that field to create it. That's what we call partnership between public, which is government, and private, which are private companies having expertise.
Sorry. Can you please explain with the help of an example?
Sure. So an example could be if government wants to build a road of 300 kilometers from source X to destination Y, government will have an option to either construct it by itself. What it does is hire a contractor and takes a quote. It will pay the contractor on a sum basis, maybe monthly, or based on completion or some other criteria. So it's a straightforward contract. This is called engineering, procurement and construction, in short EPC contracts. In this project normally winds up based on completion of road. After this, government will look for someone to operate and maintain it.
How is PPP different from this type of contract?
PPP is entirely different ball game. It is an option with the government to award a project as a long-term package. So government may award a project to any road expert company and only manage the working. All the major tasks such as design, construction, operation, maintenance and even financing is done by private company. It's a brilliant way for government to build more assets in less time.
That's amazing.
Marisa, also please be aware that governments work differently than private advisory. The main reason for this is the objective behind the project. Therefore, governments do not work for profits, however private players work for profits. Government work for creating a social impact. They build infrastructure for public use at large.
Okay, that's helpful. I have a query. If you say governments do not work for profit, why do we assess the project financially? We create financial model for them and see how much profitability a project is providing, and based on that the project is awarded. Correct me if my interpretation is wrong.
Yes. This is because governments have to ensure the project is doable. So you think of a case that we do not assess the project financially, then tomorrow the private player will come back and say I'm not able to make money out of it so I can finish the project. Alternate case could be the private player is massively squeezing out profits out of the project and pricing the public randomly. There could be a situation where there exists a monopoly in profit making, leading to a lot of variance in income distribution amongst the public.
Okay, so what is the solution?
Therefore, to curb all these, consultants need to assess any project financially. This is to analyze the actual return of the project and what can be distributed between government and private player.
Tell me a thing, Lisa. Apart from financial model, what is the government expectations from the financial consultant?
Marisa, it's not just a financial model. There has to be a detailed project report to be submitted explaining the inputs and outputs.
I request you to explain this further.
Sure. So in a public advisory, government looks at the internal rate of return, also called as IRR, of any project. So if you get all revenue and cost numbers, you will create a financial model. The result shall be either IRR or net present value, which is NPV. The difference is not much. Whereas IRR gives the rate of return a project is generating with current revenue it has. The benchmark to see whether his project is viable or not is cost of capital. So if the IRR of the project is more than the cost at which the capital is invested, it would mean the project is viable.
What is cost of capital?
So let me make you aware of these concepts quickly. IRR is a mechanism with which you get a return of your cash flows generated year on year in percentage terms. You may use a function in Excel. Whereas, cost of capital is also called WACC, which is weighted average cost of capital. In layman terms, when one starts a project, he would need money. He would either invest in the project from his own pocket, which we call as equity, or he may decide to borrow from bank, which we call as debt. So say the cost of developing the project was $100. and he decides that he would borrow $70 from bank, and $30 he would invest from his savings. This gives you weights of fundraising which will be 70:30.
Okay, so let me guess, we will multiply the weights with the respective cost of each instrument?
Correct. So he will analyze the cost of raising debt and putting from own savings. We call it cost of debt and cost of equity. Cost of debt is relatively straightforward. Just think, if you borrow money from bank, what would you give it?
So I will give interest and will repay principal.
Absolutely right. You will pay an interest at a defined interval, say quarterly or monthly, along with repayment of principal amount. Therefore, the cost of debt shall be the interest cost, which means cost attached for raising such an amount. One thing to note here is interest is allowed to be charged as a cost from income before paying taxes. Therefore, we say interest is tax deductible. This means there is an advantage of raising a debt, as the effective cost of debt becomes lower due to attached tax benefit.
Can you please explain further?
Say you are in an economy where interest rate is 10% and tax rate in the country is 40%. This means the effective rate for the borrower is not 10%, but 6% only. As whatever you will earn, you will first pay interest, and on the remaining income you will pay tax.
Does this interest rate varies for different projects?
Yes, it varies. It depends on credibility of project. Therefore, the parameters could be project location, riskiness, sponsor of project, and other factors.
What do you mean by sponsor of project?
Usually, government projects are constructed and operated in a special purpose vehicle, in short SPV, due to presence of different stakeholders. For a residential building, it would be Urban Department of State. For indoor theme park, there may be Tourism Department. For road project, there would be Transport Department. Therefore, different projects are under different SPV. By sponsor, I meant if a large conglomerate or a group with robust financials and balance sheet is bidding for these projects. This group may give a corporate guarantee while applying for loans. Other factors such as loan-raising appetite for the group as a whole may be considered.
How is it different from cost of equity?
Cost of equity is considered high as the risk is high. When an investor invests in a project, he takes over the project risk. Risk related to failure, delay, or even bankruptcy. However, the return is also high, as whatever the project is earning, you will pay fixed amount to debt providers, which is fixed interest rate and repayment to principal. Whatever is remaining, it belongs to equity providers. So the cost of raising equity is high compared to debt. Generally, in emerging economies with new projects, cost of equity varies from 18% going as high as 25%.
Really? How do you compute this?
There are many methods to compute this. There is CRPM model, dividend growth model, and many others. Usually, government considers fixed cost of equity. So, as you rightly say, the cost of debt multiplied by its ratio in fundraise is weighted average cost of debt. Similarly, cost of equity multiplied by its ratio in fundraise is weighted average cost of equity. When you add both, you get weighted average cost of capital. You use this rate to discount the cash flows to derive net present value of cash flows.
So if IRR is more than cost of capital and project seems viable, all the cash flows goes to developer?
No, so that is the whole purpose of building a financial model. We analyze the cash flows, and government may fix a required return a developer may get out of a project. The benchmark for this is market demand for a return in that period, and the remaining profit has to be shared with government.
How can we as consultants say best method to share?
It depends. Government may ask for profit sharing every year, or upfront premium for land, or annuity every year, or any other suitable method can be deployed. You may be innovative in structuring such transactions.
It was quite a much download. Thanks for sparing your time. By the way, I heard there is a party next week.
Yes, we have a party to celebrate the onboarding of new joinees every quarter. Let's catch up there.
It's wonderful. Thanks, Lisa. Tom told me about some meeting with Urban Department. Let me know of any help with the project.
Thanks, Marisa, for asking. I surely need help. We'll let you know. There is a PPP training session next week. You may like to attend this.
That's wonderful. I will surely attend the same. Thank you so much.